To wrap up our presentation today, we're going to be talking about the home buying process. Specifically, we will talk about the different types of properties that UNFCU finances. We'll talk about the different types of mortgage loans that are available and start you thinking about which options would work best for you. And talk about some of the benefits of taking out a mortgage from UNFCU, of course. And we'll wrap it up with talking about some other options that you have in terms of using your home for financing. That would be once you own the home. So let's move ahead. You're choosing a property. Now, fortunately, we had a very timely question at the end of the first session about multifamily properties. So the credit union, of course, offers mortgage loans on the single-family residence, and that's the house that you see on TV, a house with a driveway and a picket fence and a tree in the front yard. With the single-family residence, of course, you own the property. You can do whatever you'd like to with the property, subject to any type of zoning laws. But if you want to install a pool, go ahead. If you want to put on add a second floor, you're welcome to. If you want to paint the house purple, it's up to you. You can sell a single family residence to anyone you'd like to at any time. You're welcome to rent it out. So you have a lot of flexibility that goes along with a single family. A multifamily, we've already touched on this, so that's a 2 to 4 unit property. Offers the benefit of receiving some rental income for the home where you're living, and that's a really nice benefit. There is the potential negative, or at least complication, that you are now also a landlord, which means that, as with a single family residence, when you're responsible for all the repairs and upkeep and maintenance of your own home, you're now responsible for all the upkeep and maintenance and repairs for this multifamily property, especially when you have a tenant. So if your tenant's refrigerator breaks down and you need to have a repair person out there, you're going to need to do it quickly. So it's some added responsibility that goes along with that income that comes from this property. The credit union also offers mortgage loans on condominiums. So condominiums typically are found in an urban setting as perhaps sort of a glittering high-rise building. In a more suburban setting, it could be more of a like garden style apartment or condominium complex, frequently built around a golf course or a club. As with a single family or multifamily property, with a condominium, you own the physical space. It's just that it's within a larger building that has shared amenities and some shared portions of the property. So if you buy a condominium in a high rise in Brooklyn, you own the physical space, but you also own like a prorated share of the lobby and the hallways and the common areas, the basketball court, or whatever other amenities that are involved. Condominiums do not tend to have a lot of rules for their owners. I mean, of course, there's going to be some. It is living in a condominium community with an association. However, you have the flexibility to do quite a bit. You can typically rent out a condominium if you'd like to. You can sell a condominium at any time. You would have a homeowners association fee to pay. That's where you're paying your prorated share of the upkeep for those portions of the condominium association that you own as a property owner. Separate from these other types is a cooperative apartment, which is frequently called a co-op. For anyone who is familiar with a leasehold in the UK, that's pretty much how a co-op works. Co-ops exist for the most part in New York or the close New York vicinity. There are a handful of co-op properties in other large cities, Washington, D.C., Chicago, San Francisco, but not many. In New York, it's the predominant type of real estate. With a co-op, you don't own the actual physical apartment, the physical space. Instead, the co-op building has become a corporation, and you own shares in that corporation, just like you would own shares in IBM or Coca-Cola. Ownership of those shares gives you the right to occupy the property. So on a day-to-day basis, it's your apartment. You live there. But it is a different form of ownership. Co-ops tend to have a considerable amount of rules. The co-op building dictates how much down payment that you're required to make, and that's up to them, not up to us or up to you. A concern for a lot of UN staff people is that many co-ops either limit or restrict a co-op owner from renting out the unit. So again, specific to UN staff, if you were going to be away on mission for 2 years and you own a co-op that does not allow rentals, your building would sit there empty or your apartment would sit there empty while you're away on mission, and you're still responsible for all of your mortgage payment and the co-op fees that you pay to the building on a monthly basis. G4 visa holders are welcome to buy co-ops. Again, they are the predominant type of homeownership in New York City. We are a very, very frequent co-op lender, so the credit union is very experienced for both condominium and co-op lending. So we've talked about these different types of properties. Let's talk about how you own it. And what that means is really the occupancy for this home. So you could buy a property as a primary residence, which is really just what it sounds like. This is the property where you live on a day-to-day basis. At the credit union, we say it's where you go home to sleep at night. So if you are, again, specific to UN staff or anyone really, if you're working in Nairobi, but you buy a property in New York, that's not your primary residence. It may be the only property that you own, but it's not your primary residence. Your primary residence is where you're living and working on a daily basis. So if you are living where you are buying this home, it would be your primary residence. We offer homes as second homes or vacation properties. So let's say you live in New York and you want to buy a condo on the Gulf Coast in Florida, or you want to buy a cabin in the woods in the Catskills. So a second or vacation home is designed for you and your family, your friends to use, not for rental income, but for your own personal use. You simply don't live there full time. And finally, the credit union offers mortgages on investment properties. So investment properties are properties that you're buying strictly for rental income. You do not have an intention to live there. The importance, as you're going to see, on these different occupancy types is that it impacts your mortgage loan. And most directly, it impacts how much down payment you are going to be expected to make. So your down payment is that portion of the purchase price that you're paying out of your own funds. So on a $500,000 property with a 10% down payment, that means you're putting in $50,000 toward the purchase, and the credit union is lending you $450,000 for the remainder. That's your down payment. And all purchases require at least some amount of down payment. On a primary residence, which is considered the least risky for us as a lender, just statistically, defaults are, again, we have very, very few defaults on any of these properties, but defaults on primary residences are very rare because that's where someone lives. So they make every effort to maintain their payments. So we'll lend up to 95% on a primary residence in some cases. So you might buy that $500,000 property and make a down payment of $25,000 and borrow the remaining $475,000. The most flexibility is on a primary residence. The vacation home is sort of in between. There's not very much risk for us. And in fact, most rates, underwriting guidelines, and so forth are almost the same as for a primary residence. But we do expect a member to make at least a 10% down payment when buying a vacation home. And on an investment property, the down payment requirement is a minimum of 20%, just because there is a little bit more risk statistically for us or for any lender when lending on an investment property. You're always welcome to make more down payment. So what I'm touching on here are the minimum down payments. If you have a significant amount of savings, and regardless of which occupancy type it is or which property type it is, and you want to make a 40 or 50% down payment, that's great. It just means that getting a mortgage is going to be that much easier, because the more down payment that you're making, the less risk that we have in this transaction. So you're always welcome to make more down payment. These are strictly minimums. Well, we're talking about buying, and I've touched on a pre-approval before, but I just wanted to have a little bit of time designated specifically for pre-approvals. I'm sure that Lisa would agree that a pre-approval, although not obligatory on our part as your lender, is really going to be highly recommended. At the very beginning of the process, when you're meeting with your mortgage representative, you will be pre-qualified. So again, that's just based on a conversation. Maybe you have a pay statement with you. Your mortgage rep will tell you roughly what amount it is that you can borrow. A pre-approval is a much more formal step. So let's say you've already been looking at homes, you're getting a good idea of what it is that you'd like to purchase. With a pre-approval, you would submit a complete mortgage application. You're assuming that you're buying a home for $500,000, and you're assuming that you're going to make a 10% down payment, and this is on a single family residence in New Jersey. Now, these are all assumptions and can always change, but we do need to have some type of parameters in place in order to complete this pre-approval process. So you submit your application, we document your income, your assets, your credit. We fully underwrite, remember the underwriter. So we fully underwrite this loan, and we issue to you a very formal pre-approval letter that says to a seller, other real estate agents, other attorneys, any of those other parties that we talked about, it says that your financing is good. And having this type of formal pre-approval puts you into a much, much better negotiating spot. Think of it this way. A seller has two different offers for this $500,000 property. And the one borrower has no pre-approval. They just say, yes, I want to buy your home. You come in with this formal pre-approval letter, and it says that your financing is good. All you need to do is find an acceptable property. You've already gone through all the paperwork. This looks to be a fairly guaranteed and easy process to a seller, and that's going to make your offer more desirable. To be honest with you, as competitive as the market has been, there are certainly real estate agents and sellers who do not necessarily even want to entertain an offer without having the pre-approval. So again, not required by us, but we wholeheartedly recommend it. Okay, so we've talked about properties. Now let's talk about which mortgage is going to be the right one for you. The first type of mortgage program that we offer is called a fixed rate mortgage, and it's exactly what it sounds like. You're borrowing $450,000 or whatever the loan amount is for a fixed amount of time, 10, 20, 30 years. The interest rate will be fixed for the entire life of the loan, so it will never change. So there's a lot of security that goes along with a fixed rate mortgage. You don't have to worry about budgeting because your payment's never going to change. Especially for someone who plans to live in a home for many years, a fixed rate mortgage is, probably a pretty good option to consider. There are some drawbacks to a fixed rate mortgage, and the main one is, especially when we compare this to the other type of program, and I'm going to give you some comparison examples, you're going to pay a slightly higher interest rate for getting the benefit of that long-term fixed rate. So the interest rate is going to be a little bit higher on a fixed rate mortgage, which means you'll qualify for a little bit less of a mortgage loan. So the other type of mortgage loan that we offer is called an adjustable rate mortgage, or ARM. So this is a loan set up for either 15 years or 30 years. Instead of having the interest rate fixed for that whole term of the loan, the rate would be fixed for the first couple of years. 3 years or 5 years or 10 years. We have a variety of different programs. The benefit is that for that first or initial fixed period, your interest rate will be, in some cases, quite a bit lower than what it would be on the fixed rate mortgage. The drawback is that after that initial fixed period, your interest rate will change. Rates can go up or down, and over time they do both. But there's, of course, always the opportunity to have a higher interest rate after that initial fixed period, which means you'll have a higher monthly payment. So budgeting can come into question. Adjustable rate mortgage loans are a great opportunity for someone excuse me, who does not necessarily plan to live in the home forever, which is the situation for a lot of our UN staff members who aren't necessarily going to live in a home forever. So if we go to the next slide, we can see a comparison. So we've got a $500,000 loan. On the left is the fixed rate mortgage. So it's a 30-year loan, and the rate is fixed at 6.75% for the whole 30 years. The monthly payment, this is the principal and interest, so the loan payment itself would be $3,243. On the adjustable rate mortgage, and in this example, and these are for example purposes only, the interest rate is at 6%. So for the first 5 years, the interest rate would be at 6%, and the monthly payment would be $2,998. That's a difference of $245 a month. So over 5 years, you would have saved $14,700 total with the adjustable rate mortgage, that 6% rate versus 6.75% rate. Now, you have to weigh out the pros and cons. How long do you expect to be in that home? Nobody can say for sure, but you might have your best guess about that. Do you think your income's going to change over time? Are you more concerned about stability and future retirement? Or do you think that you'll buy this home as a first-time home buyer and live in the property for 5 or 6 years, which is statistically the average, and then plan on moving on? So those are some detailed conversations that you would want to have with your mortgage representative. Your mortgage representative is also going to talk to you. Well, we've already talked about the down payments and the down payment requirements, but your mortgage rep will also talk with you about closing expenses. So again, these are going to vary. Closing expenses are going to vary by state and municipality. And they can range they can range by quite a bit. On that $500,000 mortgage, if you were buying it in New Jersey, your closing fees might be $7,000 or $8,000. If you were buying that home across the river in New York, your closing fees could easily be $25,000. So again, a lot of issues in the United States are based on a state-by-state level. So of course, it's a big consideration too. If you're buying in the New York area, and you could buy in New York or New Jersey or Connecticut, the total funds that are going to be needed for the closing expenses could impact your decision also. Listen, we would really recommend that you use our website, unfcu.org, as a fantastic resource. There is a ton of information out there available for you. Use it for all sorts of FAQs, information that has been built up over the years. We also have a really nice mortgage loan calculator. And using that, you can go in and calculate payments on any number of potential homes that you'd like to purchase. And it's a really great tool to use. And I really recommend that you go and look around the website and find all the information that we have stored there for your use. Okay, so we'll touch on some of the benefits of taking a mortgage with UNFCU also. So the credit union, of course, is devoted to some green initiatives, and we have what's called a sustainable impact closing credit. So if you are buying a new home, and that property has received certain certifications for its energy efficiency, you can get a closing cost credit that's available on any of the mortgage programs that we offer. The credit union has first-time home buyer programs. We can give you a credit as a first-time home buyer. We also offer some special financing options. Again, I've mentioned a down payment as low as 5%. There are even some opportunities for certain eligible members with a 3% down payment. We have some slightly more flexible underwriting guidelines for first-time home buyers, specifically if you go through one of our portfolio adjustable rate mortgage loan products. There's also, we had a question about a grant earlier. The credit union does have access, again, for eligible members to receive up to $30,000 in grant funds that can be used towards your closing fees and the purchase of your property. So be sure to speak with your mortgage representative about those grant programs and about the first-time home buyer program. Member loyalty rewards. If you're already a member of the credit union, then you're aware that you get reward points for certain activity, and your mortgage loan counts towards your loyalty rewards accumulation of points. So taking out a mortgage loan is a pretty big bump up in your loyalty rewards, which of course a lot of our members really enjoy taking advantage of. Finally, we're going to wrap it up with how you can use your home in the future. Someone had mentioned about some like an equity, or Lisa was talking about having the equity in your home. So equity is the difference between the value of your home and what you owe on your home. So if your home is worth $500,000 and you owe $350,000 on your mortgage, that difference, in this case, $150,000, is the unencumbered portion of the property's value. That means that's your equity. And you can borrow against that equity for any number of purposes. As it says here, renovations to your home, education costs for your kids, just family needs, medical expenses, whatever it may be. And you access that equity by using either a home equity line of credit or a home equity loan. Both of these are technically second mortgages on your home. So your primary mortgage would stay in place. And let's say you want to take out $50,000 or $100,000, whatever it may be, based on the equity that you have. You would take out a secondary loan in the form of a HELOC, or home equity line of credit, or home equity loan. They're very similar. One of them, the home equity loan, is just you're borrowing a lump sum of money for a specific amount of time. The home equity line of credit is a revolving account, which allows you to borrow against that line of credit, pay the money back, borrow against it again. It gives you a lot of flexibility. The home equity loan has a fixed interest rate, and the home equity line of credit has a variable rate. So choosing between those could also depend on your specific situation or time in life, or where you are in your financial life. So a mortgage representative is, of course, always happy to discuss those options with you. And finally, listen, the credit union has a really unique program called an international home loan. And these are loans that are made to our members specifically to purchase or finance a home outside of the United States. These are not mortgage loans. So the interest rate is a bit higher because remember we talked about your home acting as collateral for the loan. And that's why, since that loan is secured by your home, the interest rates are comparatively quite low. The international home loan is not a mortgage loan, but it can be used anywhere in the world. And especially for members who are looking to purchase or finance a property in a country that has a less involved banking infrastructure, this can be a fantastic opportunity. It's very unique that we offer it. So please contact us with any questions that we can assist with on an international home loan. And I think that's it. We've wrapped up the end of the third segment of our presentation today. And I guess we have a couple of final questions before we wrap it up.
We do, Chip, and thank you for that very informative session there. A couple of additions to your comments. One is in reference to the equity of your home. There is another option that you can do, is that you can do what they call a cash out refinance on your home. And you could use that for any purposes. So if you wanted to buy possibly a second home. You could use that cash out and pay cash for that second home on your primary resident. So there's some options there beyond just the home equity line of credit, loan, and variable lines of credit. Also, the interest only, you can pay interest only, but you can also do principal reduction. So it gives you all the flexibility in the world to be able to do one or the other. So it's a great option for you for sure. And also living abroad, the international home loans has some rules around it. And so you'll need to contact our mortgage rep for our international home loans. There's a rule around you being a member for a certain period of time and some other items that you'll need to qualify for. But talk to our mortgage rep about that. So a couple other things. Let's see. We had some questions here. I still have issues to understand how the interest rates fluctuate during the mortgage, what drives that, and how it is calculated, especially at UNFCU. Well, first of all, UNFCU does not, guide the mortgage interest rates. Mortgage interest rates are guided by the bond market, and we follow that bond market, and it trades every day, so it can trade up or down on a daily basis. Now, I think part of your question is that, if you're comfortable with the interest rate that we're quoting you on a particular day, you can lock in that rate for a specific period of time, whether it be, 30, 45, or 60 days. We can go out to 90 days for that lock period. But when you lock a loan with us, though, you're basically telling us that you're comfortable with that interest rate, with that payment, because what that's going to do is that's going to protect you on any downside momentum and any upside momentum during the evaluation period until you actually close on your loan. Now, interest rates are always going to change, but when you lock in, that gives you peace of mind that your interest rate is locked in. So you can lock in your loan even though the interest rates are fluctuating all around you. So as an answer to that question. Let's see, I've got one for you, Lisa.
Sure.
Is it advisable to use a seller's agent as your agent as a buyer and basically have no attached broker?
It depends. I would encourage every buyer to get a buyer's agent. And that has to do with representation, agency, transparency, confidentiality. Like there are things that you're going to share with your buyer's agent that you may not necessarily want the seller to know. So as a seller's agent, I often get buyers who believe that they may have an upper hand by not having representation. And what I tell them often is it's like representing yourself in criminal court, right? The reality, and that may sound a little bit extreme, but it's the truth, right? Which is, this is one of the biggest decisions of your life, whether you're selling, buying, refinancing. Sometimes people's real estate, they're impacted by, people coming together, divorces, death, that you never know what may pop up. So it is in your best interest to have someone that you really feel like is your right hand through the process. That way, when you approach the seller's agent, most seller's agents, we don't necessarily, and definitely not in this environment, we don't necessarily celebrate every time we see a buyer walk into an open house without an agent, because it feels like we have more work to do, right? We now have the responsibility of not only managing our seller client, but also managing the buyer client through the end of the process. I can tell you that there are circumstances where that situation arises, where definitely in New York, I often will play the role of a dual agent. So I may represent the seller and I may also represent the buyer. I may already be representing the buyer and also end up getting a listing that may match my buyer's requirements. But I would strongly advise potential home buyers to do the work that is required to ensure that you have conducted your due diligence with respect to buyer agent representation, such that if you choose to use the seller's agent, you feel comfortable doing so.
So I think that the next question is more of a clarification question, and it revolves around the seller agent and maybe the misconception that there's an additional fee as a result of having a buyer's agent. I know that the short answer is no, that a buyer's agent fee had always been included in the fee, but if you want to maybe answer that a little bit more.
Yeah, so there is a possibility, there's definitely a possibility that you can hire a buyer's agent and not pay a fee. And the reason being is the new seller agreements, it still gives the seller the option to pay the buyer's agent. It's just the percentages for the buyer's agents are no longer publicized, and it's not a guarantee. So this is the due diligence portion, right? When you are hiring a buyer's agent, you can put parameters around what you want to search. Whether you want to seek out listings where the seller is paying the fee, whether you are already in an arrangement where you are paying your agent, therefore you're open to seeing all types of properties. But there are different types of agreements for different types of representation. Representation, it can be open, it can be exclusive, it can be limited to a particular street, it can be limited to a particular borough. Very often my agreements are for the state of New York, but it all depends on what you're looking for, where you're looking, the amount of time that may be required in order to create a buyer's agreement, and then to confirm whether or not the product you're looking for, the home that you're looking for, is offering a commission to your agent. If it isn't, then I will tell you that it's really important for buyers in today's market to recognize that they may have to pay their buyer's agent in order to get to the closing table. And that may be because the seller's agent is not paying the buyer agent fee.
And another question that says, I made an offer on a property and kind of have a change of heart. Would I be able to quit the deal without incurring a loss?
That depends on how your contract is drafted. I have a brownstone that went into contract last week, and the buyers have a 45-day due diligence period. So they have 45 days where they can conduct as many assessments, inspections, questions in order to figure out whether they are ready to lock in their interest rate and, you know, get a commitment and move forward with closing. Or, you know, depending on how your contract is structured, you could be in a circumstance where if it is fully executed and beyond a particular timeline, you may lose all or some portion of your down payment. But, you know, going back to Chip's point, that's why your real estate attorney is such a crucial part of your team. So when I am building, if I'm getting a potential lead from a lender, the lender is already on the team, right? And now they have a real estate agent. But what I'm also doing for them is ensuring that they have the inspector and the attorney so that you have an understanding of the terms that you're going to need to protect you should you choose to back out of a contract.
Excellent. I have one more question. This one is for Chip. Chip, can these good home buying services also be extended to U.S. family member, son, daughter, who is not a member of UNFCU?
Absolutely. So membership in the credit union is now open, of course, to you and staff members and their families. And in fact, pretty much anyone can join UNFCU at this time. And so not only can your family members take advantage of these programs, but so can your friends and neighbors. So if you have a great experience with us, then we would love for you to refer us along to your family and your friends, because they're all eligible to join UNFCU now.
Yes. So I think that you know, we're well beyond time, and I want to thank both of you for your expert analysis and on the current market and all that we offer here at UNFCU. I want to encourage everybody who came here today. Thank you for joining us, number one. We wouldn't be here without you. Two, if you could scan this QR code, and if you had an interest or need to apply now, that will take you to an apply now on screen here at UNFCU. A little bit about the way that we're set up. We do have, Chip has 2 offices in New York, one in the General Assembly building and one in DC too. His group primarily handles UN-related employees. And then we have another group in Long Island City that handles our alternative path members that Chip was alluding to. And this is done through a charitable organization called the Kilimanjaro Initiative. And then we have 2 offices in one in Virginia and one in Washington, D.C. The D.C. office handles primarily World Bank and IMF employees, and our Tyson's office handles the Kilimanjaro Initiative type of member. And this is really anybody who resides in the U.S. can join us through KI. And so that makes us available to many population groups throughout the United States. So that's the way we're set up from an organization standpoint. And you'll see those questions asked when you do the QR code. And each one of our groups are expertly trained to handle your questions depending upon where you are. And by the way, every one of our mortgage reps and our loan officers can lend in all 50 states. And so we're very well equipped to handle the entire US. So again, I want to thank you for joining us. The recording will be distributed. And I just want to encourage you again to make an appointment and to continue the conversation with a mortgage rep and or loan officer. Thank you again for your attendance.